Investing in the stock market can be one of the most rewarding ways to grow your wealth over time. But it can also be incredibly risky if you don't approach it with the right knowledge and strategy. Many beginners, and even some seasoned investors, fall into common traps that can cost them a fortune. In this video, we'll explore the biggest mistakes people make when investing in stocks and, most importantly, how you can avoid them. Stick around to the end for actionable tips that will help you build a more secure and profitable investment portfolio. One of the most common mistakes is investing without a plan. Too many people jump into the stock market because they've heard stories of friends or family members making quick money. They invest based on emotions or the latest hot stock tip, without any clear goals or strategies. This approach often leads to losses. Before you invest a single dollar, you need to define your objectives. Are you investing for retirement, to buy a house, or for your child's education? Your goals will determine the types of stocks you invest in and your overall strategy. Remember, investing is not a get-rich-quick scheme, it's a long-term commitment. Another major error is failing to diversify. You've probably heard the saying, "Don't put all your eggs in one basket." This couldn't be more true in the world of investing. Many people make the mistake of putting all their money into a single stock or industry because they believe it's a sure bet. But even the most successful companies can face unexpected challenges. By diversifying your portfolio across different sectors, industries, and even asset classes, you reduce your risk. For example, if you invest in technology stocks, consider balancing your portfolio with healthcare, consumer goods, or even bonds. Chasing trends is another pitfall that many investors fall into. It's easy to get caught up in the hype when you see a stock's price skyrocketing. But just because a stock is popular doesn't mean it's a good investment. Often, by the time a stock becomes a trend, much of its potential upside has already been realized. Instead of chasing trends, focus on finding undervalued stocks with strong fundamentals. Look for companies with solid financials, a competitive advantage, and a history of steady growth. A big mistake that's often overlooked is not understanding what you're investing in. Investing in a company's stock means you're buying a piece of that company. But how can you evaluate whether it's a good investment if you don't understand the business? Many people invest in companies simply because they've heard the name or because it's a well-known brand. Always do your research. Study the company's financial statements, business model, and industry trends. The more you understand about the business, the better equipped you'll be to make informed decisions. Letting emotions drive decisions is another major error. The stock market is volatile, and prices can fluctuate dramatically in the short term. It's natural to feel excited when your stocks are up and anxious when they're down. But making decisions based on fear or greed is a recipe for disaster. For example, some investors panic and sell their stocks during a market downturn, locking in their losses. Others become overly confident during a bull market and take on excessive risk. To avoid this, create a plan and stick to it, regardless of market conditions. Remember, discipline is key to long-term success. One of the biggest killers of investment returns is trying to time the market. Even professional investors struggle to predict market movements accurately. Trying to buy at the lowest price and sell at the highest is nearly impossible and can lead to missed opportunities. Instead, focus on a strategy called dollar-cost averaging. This involves investing a fixed amount of money at regular intervals, regardless of market conditions. Over time, this approach can help you smooth out the impact of market volatility and build wealth steadily. Another common mistake is ignoring fees and costs. Many people overlook the impact of brokerage fees, transaction costs, and expense ratios on their returns. These costs may seem small at first, but over time, they can significantly eat into your profits. When choosing a brokerage or investment fund, pay close attention to the fees. Look for low-cost options that align with your investment strategy. Also, be mindful of taxes. Selling stocks can trigger capital gains taxes, which can further reduce your returns. Consult a tax advisor to develop a strategy that minimizes your tax liability. Failing to rebalance your portfolio is another error that can lead to problems. Over time, Some investments will perform better than others, which can cause your portfolio to become unbalanced. For example, if your technology stocks have gained significantly, they may now represent a larger portion of your portfolio than you initially intended. This increases your risk. Regularly review and rebalance your portfolio to ensure it aligns with your goals and risk tolerance. Another mistake is focusing too much on short-term performance. The stock market is inherently volatile, and prices can swing wildly in the short term. Obsessing over daily price movements can lead to stress and impulsive decisions. Instead, take a long-term perspective. Successful investors focus on the big picture and understand that short-term volatility is just noise. Evaluate your investments based on their performance over years, not days or months. Relying too heavily on stock tips and predictions is another trap to avoid. It's tempting to follow the advice of friends, family, or so-called experts. But no one can predict the future with certainty. Instead of relying on tips, develop your own investment strategy based on thorough research and analysis. Trust your judgment and avoid the herd mentality. One overlooked mistake is not having an emergency fund before investing. Life is unpredictable, and unexpected expenses can arise at any time. If all your money is tied up in the stock market, you may be forced to sell your investments at a loss to cover an emergency. Before you start investing, build an emergency fund with 3 to 6 months' worth of living expenses. This will give you peace of mind and allow you to stay invested during market downturns. Neglecting to review and update your investment strategy is another pitfall. As your financial situation and goals change over time, your investment strategy should evolve as well. For example, as you approach retirement, you may want to shift from growth-oriented stocks to more conservative investments like bonds. Regularly review your portfolio and make adjustments to ensure it remains aligned with your goals. Finally, one of the most significant mistakes is not starting early. The power of compound interest is one of the most effective tools for building wealth, and it works best over long periods. The earlier you start investing, the more time your money has to grow. Don't wait until you have a large sum of money to start. Even small amounts can grow into substantial wealth over time if you invest consistently. To summarize, the stock market offers incredible opportunities, but it's essential to avoid these common pitfalls. By investing with a plan, diversifying your portfolio, managing your emotions, and focusing on the long term, you can set yourself up for success. Remember, no investment strategy is foolproof, but by avoiding these mistakes, you'll significantly improve your chances of achieving your financial goals. Thank you for watching this video. If you found this content helpful, don't forget to like, subscribe, and share it with others who might benefit. Let us know in the comments if you have any questions or topics you'd like us to cover in future videos. Happy investing, and we'll see you in the next one.